Okay, good evening, everyone. Again, my name is Jason Maida. Again, welcome to the Los Angeles Homebuyer Workshop. We're going to go ahead and get started this evening and kind of get into tonight's content. If you missed it earlier, we're going to try to make our workshops very interactive for you. So we encourage questions as we roll through tonight's content. You can use the Q&A function here in Zoom, and then we'll go ahead and answer some of those questions on air. And hopefully that'll be helpful for you as we go through tonight's discussion. So let's before we roll into tonight's content, let me tell you a little bit about me. So again, my name is Jason. I'm the branch manager here at the American Pacific Mortgage. Now, we're based out of Sacramento, but we service all of California from our office. In fact, we service a few states here from Sacramento, and we specialize in first-time homebuyer programs. And so you're going to learn a little bit more about those this evening. And so we work with an agency called CalHFA. So that's the California Housing Finance Agency. So you're going to learn a little bit about down payment assistance programs that are available if you're in need for assets and additional support and resources to help you in home buying. So with these classes that we teach these about every other week. So if you like what you hear this evening, really encourage you to share this information with your friends, family, maybe some of your colleagues that might enjoy learning a little bit more about home ownership. And especially with so much going on right now in the economy, it's really great to hopefully hear some information that's going to help you on that journey towards home ownership. So let's talk a little bit about tonight's talking points. So we're going to learn a little bit about the housing market, what's going on. We're going to kind of have most of our talk be focused in on the Southern California markets, considering this is an LA class. We're going to do a rent versus buying analysis, talk a little bit about credit, student loans as it impacts potential qualifying. We'll look at various loan programs for you, income and assets needed for qualifying for your mortgage, or like the documentation typically needed. We'll talk about some of those down payment assistance programs offered through the California Housing Finance Agency. And then we'll wrap up tonight's discussion. We'll learn a little bit about the process. So there's the 6 steps of home buying to go from pre-approval all the way to the very final stage, which is step 6 of closing your home loan. And I'll talk to you a little bit about a consultation and what that can look like for you and what it means to be pre-approved for your home purchase. So that's what it looks like for our talking points this evening. So let's go ahead and jump right in. And the first thing we kind of have to ask ourselves is, like, does buying make sense for me? Because, given maybe the cost of rent or maybe the cost to own, it may not make sense for you. So I think, really it's important to take the time and do your discovery work, which obviously those of you that are joining tonight's class are doing, because you want to kind of study up, do your research and see if buying does truly make sense for you. But when you think about buying, there's a lot of great benefits that come with it. You're the ability to be able to create like stability in your housing payments. So creating like an affordable situation for yourself. It's an asset. So being able to pass that asset down to the heirs of your estate. When you own a home and the home grows in value, that's called equity, because the equity is the difference of what you owe on a house versus what the market value is for your home. So a lot of homeowners that we've helped over the last several years, especially in the last 2 to 3 years, have seen immense growth in equity. And, that's kind of the investment that you get in owning a home. And finally, there's still some great tax benefits that come with owning a home. So, that's another thing that we have to think about. So when we're comparing our budget now, we don't want to just necessarily look at what my rent is, compare that straight up with a mortgage payment. There's a lot of great value adds that go into being a homeowner as well. So as we do that budget analysis, I want to kind of take you through a tool that we start our workshops off with, and it's called a rent versus buying analysis. And this is brought to us by Freddie Mac. And all of these tools that I share with you this evening, we're going to be sending those out to you via email after tonight's class. So you'll be able to get a chance to do your own kind of personal, like, buy versus rent analysis. So I'm going to take you through one scenario here. We'll kind of just hopefully make it more realistic to the Southern California markets, just to see how the tool works. And let's say we kind of look at a rent situation. Let's assume like $2,500 a month in rent, and every one of these fields you'll kind of plug in the data, and then it'll go ahead and give us back, what the savings or maybe the takeaway would be by renting or owning. So let's say we have a monthly rent of $2,500 a month. We'll assume monthly renter's insurance of $15, and then let's assume that our rent is going to go up about 3% every year. Okay. And then let's plug in for the home purchase. I know it's going to vary based upon where we buy in the LA market, but I'm going to go ahead and put $550 in for now. That could be, a single family home, could also be a townhouse or a condominium. The minimum down payment on a $550 purchase price is 3%. And we're going to talk a little bit more about that when we learn about loan programs. Property taxes estimated about $6,200 a year at a $550 purchase price. So we want to factor that into our budget. Homeowners insurance, and annually, let's say it's $1,000 a year in homeowners insurance. The cost of kind of maintaining our home, we're going to plug in $1,500 for that. And then for our loan information, we're going to assume a 30-year fixed mortgage. So for most of the programs that we're going to discuss this evening, we're going to be talking around 30-year fixed mortgages, but we're going to do a little bit of an interest rate analysis this evening. I'll show you the difference between 30-year fixed mortgages and adjustable rates as well. But let's start off with a 30-year fixed for this exercise. And then for the interest rate, we're going to plug in 5.875%. That's about the average interest rate today. Although, as we're going to learn a little bit more here in just a bit, it does fluctuate daily based upon kind of financial conditions. Origination charge, that's going to be what your lender charge is going to be for your financing. And then there's a thing called discount points, and discount points allows you to achieve a lower interest rate. And we're seeing a lot more of that in this market because of where interest rates have kind of risen to. It gives you the ability to be able to achieve a lower interest rate by paying additional cost. Generally speaking, one discount point or 1% of your loan amount will lower the interest rate offering by about 0.25%. So let's say I'm going to finance, let's say $500,000. 1% is $5,000, which would bring down that rate 0.25%. So in our example here, maybe instead of a 5.875% rate, or 5.875, we're looking at a 5.625 rate if we decided to pay discount points. And then we're going to plug in $4,000 for other settlement charges. So when we think about savings for our home mortgage, there's going to be the down payment, but there's also going to be closing costs. So we want to factor that into our budget. Generally speaking, the overall closing cost can be estimated anywhere between 2 to 3% of our purchase price. Okay. And then we have our other assumptions, which appreciation of our new home, we're going to say is about 3%. Expected years in the home, 7 years. The cost of selling the house. Now, when I buy a house as a buyer, when I have a realtor that represents me, I don't pay the commissions that realtor earns. Those are actually paid for by the seller. But when I turn around in 7 years from now and decide to sell my house, then at that time I would have to pay the commissions to not only the buyer's agent, but the listing agent who is representing me to sell my home. So, but as a buyer, we don't have to worry about that cost at this point. And then we're going to plug in state and federal tax rate. And then we also have our savings rate. So what happens is this calculator goes in and says, okay, if I'm going to go ahead and make my rent payments of $2,500 a month, and I compare that to the investment that I'm going to make in home ownership. So I have on this side, I have my $2,500 a month in rent that will grow about 3% per year in cost, versus a higher mortgage payment. It's about $1,900 a month difference in mortgage payment, but my opportunity over 7 years is about $39,000. And of course, the longer we stay in our home, potentially more equity grows, but on average, most clients are staying in their home anywhere between 5 to 7 years. Okay, so I would encourage all of our attendees tonight to try to do that calculation yourself and see what that comes up as. Now, of course, if you're spending $500 a month renting a room and you're looking to buy a $550,000 house, that math is probably not going to work so well. But certainly, if you kind of plug in average rents to the for the LA area and you look at average sales prices, that math could be favorable for you in home buying. So, but I would encourage you again just to kind of take a look at that on your own after tonight's class. Okay, so that's the rent versus buying calculator. Let's go ahead and continue on. And I want to talk now a little bit about the housing market. So there's a lot going on with the housing market. This is typically the busier time of year, although at the same time, the market is transitioning in a little bit, and interest rates, which we're going to talk about in just a minute, has a lot to do with that. If we look at the market and the challenges we've seen from a buyer's perspective in the last couple of years, really resulted as a product of lower interest rate environment, but less inventory to choose from for buyers. So it really created this hyper competitive market. And a lot of that began right here, which this gray line represents the start of the pandemic. So at the start of the pandemic, things changed from a job perspective. We had less, owners going to, or buyers looking to, make that long commute. They'd rather purchase maybe in more of a lesser densely populated area and, look at trying to purchase in those areas. And that drove up prices, of course, and again, the interest rate environment that we had. And so that stay-at-home kind of work environment led to a change in kind of buyer demands. And so we saw a really heavy push of buyers entering the market, very little inventory. And then as we can see, with our good economics 101, supply and demand, right? We saw prices kind of push north, and that trend had continued into 2022. And what we've seen change a bit is over the last 2 months, 2.5, 3 months, we've seen interest rates start to move upward. And now we're starting to see that little bit of a crest here in home appreciation. So we're starting to see that level out a little bit. Homes are starting to stay on the market a little bit. Now we're seeing sellers with some reduction in price, sellers that are a little bit more flexible in their price, because now they're not getting 20 offers, maybe they're getting 2 offers on a place. So that is starting to switch a little bit. I wouldn't categorize it yet as a buyer's market yet, because I don't think we're quite there, but I will certainly say it's a softening in the market. And so that definitely positions, especially our first-time homebuyers, in a much better position than we were before. Now, we all know interest rates have changed. I'm sure many of you are watching what's going on in the economy and seeing kind of what interest rates are doing. I mean, we have some concerns around inflation. Obviously, we saw the latest inflationary numbers coming today. Again, inflation is a big concern. And at the end of the month, we're going to be kind of watching to see if the Federal Reserve decides to raise rates upwards of 0.75%. And so some of that is already kind of baked into mortgage interest rates that we've already seen. But there are some obviously big time inflationary concerns, and then obviously down the road, possible recessionary concerns. So there's a lot going on in the market right now. And when we look at interest rates, interest rates are going to drive some of our purchasing power. And so this is kind of, and we're going to pay our attention to the interest rates over the last 5 years. As we can see here in this slide here and we're going to look at the blue line. This level of interest rate from the start of the pandemic all the way to, really first quarter of this year, we saw this, low 3% interest rate environment as, on average. And then, as I mentioned earlier, Q1, Q2 of this year, we've seen interest rates really skyrocket. And you can see interest rates have touched as high last month as almost to the 6% level. So right now we sit at that 5.875 level, and that's obviously changing some of the buyer behaviors a little bit, and obviously changing what we've seen from an inventory level in the market. Now, I mentioned to you earlier that we talk a little bit about the 30-year fixed mortgages as it compares to what we call adjustable rates. And adjustable rates are something we just really don't recommend for first-time homebuyers, because as it says, it's an adjustment. So at the end of that term, that loan could potentially adjust upward or down. And this chart off to the right that I'm kind of spotlighting here shows the difference between a 30-year fix, which is right here, versus in red or orange is the 5/1 fixed arm. And you can see that's still about in the mid, or we'll say low 4s. So there's not quite the spread that we typically would see in a high rate environment between an adjustable rate and a fixed rate. And we call that an inverted yield curve. So we're not seeing short-term and long-term rates create a big separation. So generally, when we see this high rate of market, we'll have more clients that are more interested in adjustable rates, but not for first-time buyers, for second and third-time buyers. We're just not seeing that in this market because it just doesn't make sense. The trade-off to take a lower interest rate on a 5-year fixed mortgage versus the security of a 30-year fixed mortgage just doesn't pencil out. But at the end of the day, as first-time homebuyers, we really want to be focused on a 30-year fixed mortgage, just because it creates more predictability when it comes to our affordability for our home purchase. Now, the slide off to the left shows interest rates over the last 25 years, and so you can take some time to look at that on your own. But clearly, the interest rate changes will influence basically our purchasing power. The market today remains super volatile. We'll see changes every day, and changes can move by the second in the financial market. So, a good kind of rule of thumb, something to look at to see what mortgage interest rates are doing is kind of watch what the 10-year treasury is doing. Usually the mortgage-backed security market will fall in sync with what's going on in the 10-year treasury world. Now, all interest rates are not kind of created equal in terms of the characteristics that go into an interest rate for every consumer, because every interest rate has a different level based upon your credit eligibility. So the higher FICO score you have, so if you're a 740 credit score or higher, you could have potentially lower interest rates. The product you select, the loan amount, how much you finance, how much you decide to put down. So if I put down only 3%, versus 20%, that could change my interest rate offering. And as we heard earlier, you have the opportunity to be able to buy points or be able to buy down your interest rate. Like we said earlier, 1 point or 1% of your loan amount can potentially lower your interest rate about 0.25%. So that's factored into interest rates. And finally, the term of your loan. So the lower your term you take for your mortgage, typically can get you a lower interest rate. If you go from a 30-year fixed mortgage to say a 15-year mortgage, generally speaking, that will lower your rate up to about 0.5%. Okay. All right, so we learned a little bit about the market, interest rates, and kind of what's going on there. And one of the characteristics that we said plays a role in interest rate offering is going to be credit. And it's really important for us to counsel our clients in credit and make sure you're in the best possible position so you can have the best purchasing power when it comes to taking that next steps to owning your home. So let's talk a little bit about credit. This slide kind of shares with you a little bit about the FICO score calculation, what's weighted in FICO score. So 15% of the FICO score calculation is going to be how long I've had credit. So the longer, more mature my credit file is, potentially the higher my credit score can be. 20% is going to be now how much credit I have newly in use. So if I've opened up new accounts, that's going to have an impact on my score. Also, inquiries will play a role in that 20%, specifically hard inquiries. So we always want to try to limit our hard inquiries. Now, when we start our process with American Pacific Mortgage, we only start with a soft credit inquiry, which doesn't impact your credit score. Now, there is a rule with inquiries for both the auto industry and the mortgage industry. So you can apply with as many lenders as you want. And as long as that's within a 30-day span of time, it's the equivalent of one credit inquiry impact to your score. Now, 30% is going to be how much I owe on my revolving credit balances. So my lines of credit, my credit cards, that's called utilization. That's a 30% weighting. So if I have $10,000 in credit limits and I owe $5,000 in balances, then I have a 50% utilization. Generally speaking, we want to keep that utilization below 10%. That's going to help you optimize your credit score. If you're running a little bit higher on your optimization, let's say you're at 70, or sorry, your utilization, if you're up at 70, maybe 80%, our goal should be really try to push below 50% is kind of our starting point. Okay. And then finally, the last component to the weighting is payment history. And that's basically how I paid my bills, right? So the weighting or the delinquency days are generally in 30-day lates, 60-day lates, and 90+ delinquencies. Any lates that I've had in the last 12 to 24 months are going to be the most impactful to my score. So if I've had a late just recently, that's going to be more damaging to my score. And then the further I can get away from that delinquency, so the further I go out in my kind of my kind of runway, if you will, then I'll see kind of organic improvement in my score. So what I mean by that is if I had a late in October of 21, as I move into say 23, the further I get away from that delinquency, the better my score should hopefully be. I want to kind of jump back really quick to amount owed and talk to you a little bit about utilization and maybe a way of managing your credit cards. So if you look at all of your credit cards, there's a billing cycle date on each one of those cards. And at the end of that cycle date is when the credit card issuer sends out all the data to the credit bureaus. So Experian, Equifax, and TransUnion, and tells them what your balance is versus your credit limit. And if you're in the habit of paying down your balances or paying them off every month, I would encourage you to try to pay those off before the end of that billing cycle date. Because if I can try to pay that down or pay it off, the information that's sent out to the bureaus is going to show much more favorable, right? So if I have, let's say, a credit balance of $5,000 on my $10,000 credit limit card, but I'm in the habit of paying it off every month, as long as I pay that off before the billing cycle date, let's say it's the 20th, so I paid it off on the 19th, that means I have a zero balance. So on the 20th, that data gets pushed out to the bureaus, and now my utilization would be much lower versus having that, say, that 50% utilization if I decided not to pay that balance until the actual due date. So I would encourage you, as if you're really trying to drive down utilization, try to make those payments or payoffs before the end of the billing cycle date. Okay, now every loan program that we're going to talk a little bit about tonight has minimum credit scores. The FHA loan is a 580 minimum credit score. Conventional loans, 620. Our VA loans for our veterans that have served is 620. There's a program called USDA as well. That has a minimum credit score of 620. And then the CalHFA product for our first-time home buyers is a minimum credit of 640 for FHA and then 680 for a conventional loan. Okay, there's a couple of things I want to talk about on the credit section, and then we're gonna move into some other topics here. But one of the things we want to kind of talk a little about is account closure, and that has to do with revolving credits. As we learned earlier, 15% of our score is length of credit, so it's really important that if you're in the habit of maybe opening up a new credit card and doing a balance transfer, you want to be mindful that if you do that balance transfer and then close out that old credit card, when you close out the old credit card, it takes away all that reporting history from your FICO score calculation. So if possible, if you're in the habit of doing balance transfers, opening up a new card, try not to close that old card, and especially if it's one of your oldest active accounts, because that can really hurt you from a length of credit perspective. And if at all possible, never try to close revolving accounts out, because those also will take or be pulled out of the credit utilization. So if I have an aggregate $10,000 in credit cards and I close out $5,000 of the credit cards, now I can not only impact my length of credit, but I'm also going to hurt my utilization. So we want to be careful with that. And then finally, when it comes to credit scores, we always look at what we call the middle score of all three bureaus. So again, there's TransUnion, Equifax, and Experian. If I'm at 740, 720, and 700 on my scores, as a lender, we're going to utilize the 720 score for qualifying purposes. Now, if I'm a 720, but my spouse is at 700, 680, and 660, we do take the lowest score between both borrowers. So we would actually use the 680 credit score for qualifying purposes if I'm applying jointly with that application. All right. To wrap up in the credit section, I want to talk to you a little bit about kind of negative items. This matrix kind of shows you how long things will stay with you on your credit report. So hard inquiries are going to be on your credit report for 2 years. Late payments, collection, judgments, those will all be on your credit bureau for at least 7 years. If you've had like public records that are bankruptcies or tax liens, it's 10 years or less. And then federal student debt can be, or tax liens can be on your credit report indefinitely. This month, the credit rules changed where medical collections will no longer be on your credit report. So if those of you that are attending tonight have had challenges with medical collections, those shouldn't be appearing on your credit report going forward. Okay, so one of the things that comes up quite a bit as we're consulting with clients is student loans. And for those of you that do have student loan debt, all the federal student loans are in deferment right now, I believe until September. But when you qualify for a mortgage, we still have to count a minimum payment in the calculation for qualifying. So for most of us that have federal student loans, for example, there shows a 0 payment right now because those are in deferment, unless you have an active payment plan right now. Private student loans will generally have a monthly payment showing, but we do have to figure out what that monthly amount is that we have to count towards our qualifying. So if you're on an income-based repayment program prior to the pandemic, so let's say it was $200 a month or $250 like we have in the example here, that's what we're going to use for qualifying purposes. But if you don't have an income-based repayment program set up, then we have to, on an FHA loan, use 0.5% of the balance, or for a conventional loan, we'll use 1% of the outstanding balance. So it's more beneficial generally for clients to use the income-based repayment amount, and that's something we would talk about through a consultation with you. If you're going back to school, for example, and you don't have a payment because of that, we still would have to count a minimum payment for you for qualifying purposes. Okay, so let's look at loan programs now. And generally, there's like 5 core programs that we look at for financing. There's the conventional loan, which has a minimum down payment of 3%, FHA with a minimum down payment of 3.5%. VA loans are going to be for our veterans that have served, that have VA eligibility. And then the USDA loan is going to be for more of our rural areas. So maybe some of our desert communities will qualify. And then jumbo loans are going to be for clients that are looking to purchase with a much higher purchase price. Generally, they're going to finance more than $970,800. And those minimum down payments are quite a bit higher than what we call it the agency products. So they'll generally be like 10 to 15% down payments. One of the things I always like to make note of on a jumbo loan, if you decide that's going to be your first step in home ownership, is not only you're going to have to save up money for your down payment and those closing costs, that 2 to 3% of your purchase price, but you'll also need money for what we call as reserves. And reserves are additional assets that I have left behind that shows kind of some additional financial stability if I was able to, say I lost my job or something. And those reserves are going to be usually 12 to 18 months of my monthly payment. So if I have a $5,000 mortgage payment and I have 12 months of reserve requirement, that means I need to have $60,000 in assets in addition to my down payment and closing costs. Now, reserves don't necessarily have to be liquid. They can be in the form of brokerage accounts, 401ks, 403bs. Those are all acceptable for reserve requirements. Bitcoin wouldn't be used for reserves. We'll talk a little bit about assets on that in just a bit here. With conventional loans, the minimum down payment is 3%. Now that 3% minimum goes all the way up to loans financed to $647,200 in LA and Orange County. If you go beyond that loan amount, that becomes now a high balance loan, all the way up to $970,800. And what's important about that is the minimum down payment for a client above $647,200 jumps from 3% to 5%. We're going to talk a little bit about PMI, or private mortgage insurance, in just a bit, but I wanted to first kind of highlight FHA loans. And FHA loans, as we learned a little bit earlier, has a minimum credit score of 580. And FHA loans are not just for first-time home buyers. It can be for second or third-time buyers. It does have a minimum down payment of 3.5%, but that goes all the way up to those high balance limits of $970,800. And then with FHA loans, it does carry with it mortgage insurance. So let's talk a little bit about mortgage insurance. And this slide kind of highlights a side-by-side comparison of conventional loans versus FHA loans. First of all, conventional loans require the mortgage insurance anytime we put less than 20% down. Now, there's a variety of different ways that we can pay mortgage insurance. It can be paid monthly. It can be split monthly, but we can also pay some of it up front. There's single premium, where you basically buy out the cost of your mortgage insurance. And then there's another thing called lender paid mortgage insurance, or sometimes it's called LPMI. And in essence, what you do is you take a higher than market rate to create a premium, or an actual profit, if you will, to be able to buy out the mortgage insurance. Doesn't happen a lot, especially in an appreciating market. More common is the monthly MI, is what we see with most clients. Now, PMI on a conventional loan is the premiums vary, and they're based upon your credit score, how much you put down, and then how much you finance. And so the more I put down, the higher my credit score is, the lesser I'm going to pay in mortgage insurance. Now, when you're looking at different calculators online, maybe it's on Zillow or Redfin or any other different websites, usually those mortgage insurance calculators are going to be much higher because they don't factor in those characteristics like credit score, down payment, and amount finance. So just something to keep in mind. We're going to talk a little bit about our mobile app just a little bit later, but I would encourage you to take a look at that. That all has prefix settings based upon credit score, so you can get a much truer monthly payment. Now, with PMI on conventional loans, the private mortgage insurance, or PMI, is in effect until we have 2 years in the home and 20 to 22% equity. So once we get that, we can apply hopefully for cancellation of the mortgage insurance. And what's important about that is, because if we get into even higher rate environment and maybe it's not an opportunity for us to refinance, if you have the cancellation option on a conventional loan, then you could potentially cancel that mortgage insurance without having to go through a refinance process. Okay, so let's look at a quick example of a conventional PMI payment setup. So if I financed $450, as you can see down here, and I had a credit score of 740, I put a minimum of 3% down, the PMI is going to be just over $183 a month. Okay, so that's what it would look like for PMI on a conventional loan. Now, if I purchased using FHA, it's going to look a little bit different. Now, FHA requires mortgage insurance whether you put 20% down or the minimum of 3.5% down. If you do put more than 10% or more, the factor of mortgage insurance drops just slightly. Monthly mortgage insurance has two components for FHA. It's monthly, but it's also upfront. So there's the 0.85% of your loan amount for a monthly mortgage insurance, and there's also 1.75 that gets added on to your amount finance. And one of the things with FHA is mortgage insurance is it cannot be canceled. You have to actually refinance to get out of mortgage insurance with FHA. So if we look at the same PMI example for FHA, now we have like I said, two components to mortgage insurance. There's monthly. So in this scenario, it's $324.32 per month. And then the upfront, which is $78.75. And so that gets added onto your amount finance. So there's two components to mortgage insurance. And so when you look at the payment options between FHA and conventional, you may say, wow, why would I ever consider FHA? And The reason why a client may consider FHA over conventional, and it has a lot to do with underwriting guidelines. So conventional loans are going to have a little bit more stricter guidelines as it relates to FICO score, as you learned earlier, 580 versus 620, maybe past challenges like bankruptcies. Conventional loans would want to see 4 years removed from the bankruptcy, whereas FHA would only want 2 years. If you maybe had a few late payments, for example, on a credit card in the last 12 to 24 months, FHA would be a little more lenient with that, whereas a conventional loan, that may be a bigger obstacle. So the variations in guidelines really would have a client maybe go down the FHA path versus the conventional loan. All right, so these are the loan limits for 2022. As we shared with you earlier, we have the LA and Orange County markets, and you can see some of our neighboring counties like Riverside, San Bernardino, Ventura, and San Diego. Now, these limits get updated every November to go into effect for the next year. So we'll probably see these changed around November of this year, and then we'll have those in place for 2023. Okay, so let's now look at qualifying income when it comes to building kind of our home buying plan. And I want to talk to you more specifically, like more about the documentation and some of the kind of the more Q&A, if you will, or FAQs, I guess you should know, with W-2 and self-employed clients. Now, first of all, with W-2 wage earners, it's pretty easy. We're going to generally need the last 2 years of W-2s, your last 30 days of pay stubs, and then we'll have to verify employment. Usually there's a written and verbal verification done once you have an accepted offer on a home. Now, for self-employed individuals, it's a little more, I wouldn't say a little more strenuous, if you will. We'd have to get a little more documentation. We're definitely going to need the last 2 years of taxes, personal and business, depending on how the business is constructed, a year-to-date profit and loss statement, and usually some type of balance sheet. And then finally, we'll verify the business either through like website, business license, maybe a verification letter from a CPA. Now, some of the scenarios that we get as we work with clients or questions that come up is, a lot of clients believe that you have to have like 2 years work history to be able to get qualified for financing. And the rule actually is you need to have a combination of education and or on the job with it matches 2 years. So the example I use quite often is if I just graduated from school and I did 4 years undergrad and now I'm going out into the workforce and I started a new job, my 4 years undergrad would satisfy that 2-year requirement. Another question that comes up is just being on the job. So you can actually start a new job and be qualified for your mortgage. So if I've been working on my job for 4 years and I'm, getting qualified, but then I'm gonna switch jobs, as long as I have a comparable pay and there's not variable pay to my new job, that can be used for qualifying purposes. One thing that does come up quite often is, clients, in fact, I had a conversation today, clients that have dual employment, whereas, and this happens in the medical profession quite often. If I'm working at one clinic for say 30 hours a week and I have another clinic I'm working out for 20 hours a week, can I count both sources of income? The only way we can count both sources is if we can show consistently we've been on that job, both jobs simultaneously for 2 years. And then if we earn overtime or incentive pay from our work, we have to show that we've been on that job for 2 years, because generally what we'll do is we'll average the 2 years of that ancillary income. So the bonus over the overtime or the commissions, for example, we'll generally want to see that. For self-employed individuals, if you've just started newly up a business, we are going to need to see 2 years tax records of that business. And finally, the last thing that comes up often is, my clients that are, working a full-time job, but maybe also doing Uber Eats or driving for Uber or Lyft on the side, that income through Uber or Lyft is going to be self-employed income because you're a 1099 employee. And so we do need to show, if we want to count that income, we have to show that we've been doing that as well as our full-time job 2 years to be able to count that towards the qualifying. Any questions on income? Because I know we get some questions that pop up with that. Okay. All right. We'll keep it going. Again, if you do have any questions, feel free to use the Q&A function and we'll get those answered on air for everybody. I want to stay with qualifying income for just a bit longer and talk to you a little bit about a calculation that we do as lenders. It's called the debt to income ratio calculation. It's pretty simple, but it takes your gross monthly income versus your monthly obligations, like your new mortgage, as well as credit cards, personal loans, auto loans, student loans. And generally, we don't want that debt to income ratio to be anywhere any higher than 43 to 45%. Now, it's a good indication of qualifying, but it doesn't necessarily dictate affordability. And so one of the questions we're going to have to figure out during our consultation with you just really what does affordability look like for you? And, whether it's a $2,500 mortgage payment or a $3,000 mortgage payment, we have to just figure out like what's the right number for you to make sure that you feel like homeownership can be affordable and certainly sustainable for you. Here's the calculation for debt to income ratio. So we have PITI, which stands for principal, interest, the property taxes, and the insurance for that new loan. PMI, which obviously we know is private mortgage insurance. HOA expense, that's going to be if we buy a condo, maybe a townhouse. Some home developments will have HOAs, very few though. $2,500 a month, we're going to make the assumption there. And then let's say our other debts are $500 a month. So the calculation is really simple. So if we take $2,500 divided by 8,500, if that's what my monthly income is, the debt to income ratio comes out to about 35.29%. Not about, but it is. Usually most first-time home buyers feel comfortable around 33 to 36%. That's generally what we see for most of our clients that we work with. Okay, so now let's talk a little bit about assets, and that's our savings that we're going to need for our down payment, closing costs, and then potentially for utilizing the jumbo financing. Then we're going to be looking at putting together money for reserves. These are some of the acceptable sources of down payment: checking, savings account statements. Any cash being deposited is going to be very difficult for us to be able to use because everything has to be paper trailed in financing. Retirement accounts can be used, 401ks, 403bs, IRAs can be used. You just want to double check with your maybe tax advisor, financial advisor before you make any withdrawals from IRA, especially because those can create tax consequences. Generally with 401ks and 403bs, you're going to take a loan against those so that you won't create any tax issue. Although at the same time, when you take a loan out against those investment accounts, it does also take the money out of the market. So you kind of lose the potential appreciation. And frequently clients will use what we call as gift funds, where family members will help them out with their down payment to be able to achieve home ownership. That can come in the form of gifted funds for the down payment and closing costs. It can be gift of equity. Can't be cash though, so that's pretty important to know. Generally, when a family member is going to gift a client, we're going to need to have them fill out a gift letter, which we already have the template to that, and then we'll just need to show some type of the proof of funds of the transfer. Okay, so as we kind of go down that path towards homeownership, as I talk with hundreds of clients, there's usually two things that get in the way from homeownership. So it's either going to be credit, because we just have challenges with credit, or maybe we're just a bit consumed with debts that we have to satisfy, or it's going to be we just don't have enough savings. Most of our clients that we work with have on average saved anywhere between $8,000 to $10,000, and so just having that obviously would not be enough for homeownership. But in partnering with CalHFA, which is designed to help first-time home buyers achieve affordable homeownership, we're able to kind of make homeownership still happen. And so I'm going to talk to you a little bit about some of the programs offered to you from CalHFA as a California resident and a first-time buyer. We're going to first talk about some of the core products that we've had for several years with CalHFA, and then we're going to switch over to one of the new programs that just launched a couple months ago. Now, first of all, the My Home Assistance Program, and by the way, both the My Home and Zip Assistance programs are designed to help moderate income families. And then we'll talk a little bit about low income opportunities for families. The My Home product allows you to borrow anywhere between 3% for a conventional loan and 3.5% for an FHA loan. And what it is, it's a low interest loan at 1%. But the great thing about it is you don't have to pay back that assistance until you either sell your home or if you refinance in the future. So as we learned earlier, the minimum down payment for a conventional loan is 3%. FHA is 3.5%. So in theory, that My Home Assistance can cover your entire down payment that you need. And so basically you would only need to contribute your closing costs. Now, if closing costs are also a challenge for our clients, then we also have what we call the Zip Assistance Program. And Zip stands for zero interest, meaning it's a repayable loan, but it's no interest on that closing cost assistance. Allows you to borrow anywhere between 2 to 3% of your purchase price, or 2 to 3% of your loan amount in that interest-free assistance that can help offset some of the closing cost assistance. Now, interest rates will vary when you move from the My Home Assistance to the Zip Assistance Program. So ideally, when we use the moderate income product, if we can put down at least our closing costs, it's going to help a lot more from an interest rate perspective. And the program has various income limits, and the income limits are based upon county. So these just actually moved upwards in June. They came up quite a bit here. Like LA County is now at 158 and Orange is at 211. So I think these are the updated limits, or actually they might even be a little bit higher because we just had a new iteration of income limits come out. We'll put that in the chat or send that out with our material tomorrow. But these income limits on this program are just much more flexible than other programs. Most first-time buyer programs are going to be up to 80% of the median income for the area. And we're going to learn a little bit more about one of those programs in just a bit. So if we kind of apply this program to a real kind of home purchase scenario, let's say we bought at $500,000. The minimum down payment's 3%, so that's $15,000. So the My Home Assistance could cover that entire amount. And then, as we learned earlier, closing costs are anywhere between 2 to 3% of our purchase price. So in theory, on a conventional loan, we probably would need $25,000 to $30,000 out of pocket. Now, if we overlay the My Home Assistance, we can take $15,000. Now we've decreased our out of pocket to maybe $9,000 to $14,000. And if we also want to add in that ZIP assistance, then we can almost get into a position where we're putting maybe $2,000, $3,000, maybe $4,000 out of pocket. Again, the trade-off is going to be we have a potential higher interest rate if we add the closing cost assistance. But these are all just fantastic tools that can help lower that money out of pocket for you. And then FHA also has an option here as well. So if we have to go down the FHA path, we can get that same 3.5% of My Home Assistance, so $17,500. And then if the ZIP assistance is needed, we can also use that to help decrease the out-of-pocket expense. Okay, so that program is designed to help our moderate income buyers. And then the new product that I just talked a little bit about earlier is called the Forgivable Equity Builder Program. This program had a big launch. You saw it on ABC7 up in LA. We had San Jose Mercury did a spotlight on this, and we also had some work in the Sacramento area. And the Forgivable Equity Builder Program allows low-income borrowers to borrow up to 10% of their sales price or their appraised value, whichever is less. And it's interest-free, but the great thing about it is completely forgiven as long as they live in the property for 5 years or more. Now, it's based upon 80% of the median income, which in the LA market is going to be $78,320. So if I make up to that amount, I could potentially qualify for this assistance. Now, it can't be combined with the My Home or the ZIP program, so it's kind of a freestanding product. So now if I took that same $500,000 purchase price, I would get up to $50,000 in assistance that can be used entirely for my down payment, or I can split that between my down payment and my closing costs to help reduce my overall monthly payment, which is a fantastic opportunity. One thing I want to just let's see. Just a quick side note with this program. You can add additional assets to the Forgivable Equity Builder Program up to 20% of your purchase price. So if I had a family member willing to gift funds to me, I can put a total of 30% down, between 10% from the state and 20% from my own source of funds, so up to $150,000. But that's the maximum that you can put in addition out of pocket, but more assets can be used. So some of our clients that are buying in higher cost of living markets like LA and Orange County, even in our Bay Area markets, that's a way to be able to utilize that program if they qualify. On these programs, the minimum credit score is 640 for an FHA loan, 680 for the conventional loan. Now, if you qualify under the Equity Builder Program, the minimum score is only 660 for the assistance program. As we learned earlier, there's the debt to income ratio, which is a maximum of 45%. One of the great things about this program is the income guidelines are based upon the applicant's income. And we've seen this a lot, especially utilizing the Forgivable Equity Builder Program. Let me get back here. That if I have a household, let's say my total household income is $150,000, but I only make $80,000 or $70,000, and I'm within the income limits for the program. If I'm able to qualify in just my name, then my partner's income is not factored into the qualifying as long as they are not on the application. So that's a great way of being able to stay within the guidelines. And that's kind of to this next point where if I'm married, and even though I'm married, I can still apply without my spouse to be able to stay within those income limits. Now, a first-time home buyer is someone that hasn't owned in the last 3 years. So if I owned back in 2008, maybe I sold my house in 2012, as long as I haven't owned in the last 3 years, I'm still considered a first-time buyer. This is for any one-unit property. So single-family homes, new construction, condos, townhouses, even manufactured homes that are on permanent foundation. It's land that is owned. It can't be like in a mobile home park or anything like that. It has to be actually on a real land, or we call it real property. Okay, so that's the CalHFA Assistance Program. We can always kind of do some backtracking if you have any more questions on that, but just a fantastic program to help you achieve home ownership. Let's talk a little bit about the process of buying. This is called our 6 steps of home buying. And I'll walk you through each one of these milestones to show you kind of what it looks like on your journey towards the final stages of home ownership. Now, step 1 is going to be pre-approval in the process, and the pre-approval is the output of a consultation, and we basically design your pre-approval through a consultation. That's like a 30 to 45-minute session we do with you. That pre-approval certificate is given to a seller to show the seller that you're eligible for your financing. It's usually valid for 60 days, but we can always recertify your pre-approval at any time. And after you've gotten a pre-approval, then you're going to go to the fun stage. That's called the house hunting. And that's where you're going to get a chance to partner with a realtor. We have a fantastic network of preferred realtors. If you want us to make a connection for you, we're more than happy to do that, or you can find someone on your own. But you'll get a chance to look at different homes. That pre-approval letter, we can update the terms of that pre-approval. So maybe I get pre-approved at $500,000, but I fall in love with a $450,000 house. We can always tweak that pre-approval to match that offer price of $450,000 for your house. Step 3 is going to be entering escrow, and entering escrow is when a seller has accepted an offer on my house. And usually the escrow time period from step 3 to step 6 is when I get keys. It takes about 30 days. So a lot of our clients that have had their offers accepted today, they should be getting their keys on August 13th. And so that's kind of the typical timeline, if you will. Sometimes it's a little bit shorter, as short as 21 days. Within 2 to 3 days of the acceptance, those buyers will have to make what we call an earnest money deposit. And I'll show you a slide about that in just a second. But usually that earnest money deposit is 1 to 2% of your purchase price. And that money that you make on deposit goes towards your total out-of-pocket expense. Now, within 24 hours of your acceptance, we're going to get connected with you to do what we call a follow-up consultation. That's where you get a chance to go through your interest rate, your payment, your out-of-pocket expense, go through the process to make sure you feel comfortable with everything. And then we kind of launch into that escrow time period in the next milestones. We're going to order appraisals on your property. Inspections will be ordered by your realtor. And you're going to be in the middle of what we call the contingency period, which I'm going to share a little bit more about that with you in just a bit. This is a slide about the earnest money deposit. Again, it's about 1 to 2% of your purchase price. That money gets held with the escrow company because the seller doesn't get access to those funds, because generally you can do have your purchase agreement subject to a contingency period that allows you to do your due diligence on the house. That includes getting your house appraised, which as the lender will order that appraisal, getting your house inspected. Your realtor will help facilitate that. And then as a lender, getting your loan approved. And usually that time period is anywhere between 14 to 17 days. In the height of the market, when homes were just moving really fast, we'd have to slim those contingencies down to 10 to 14 days. But generally, we're able to give you, about 17 days based upon, negotiations with the seller, and your realtor will help facilitate that. So that contingency period usually is from step 3 to step 5. So that's where you're going to do your due diligence. Step 4 is going to be processing and underwriting. That's where our team does more of the administrative functions on your home financing. We verify your employment, your assets. We may need some additional documentation to prepare us for underwriting. Your rate has generally been locked by that time. You've received disclosures that are signed via e-signature. And once we've finished up in step 4, then we're going to submit everything to our underwriting team, who will go ahead and complete a full underwriting review and hopefully issue your loan approval at step 5. Now, step 5 brings us to probably about 75% of the way there through the process. And at step 5, you're also going to be asked to remove your contingency for your loan. As long as you feel comfortable with the inspection work, the appraisal, and of course you have your loan approved, then you would release your contingency. It's important to know that once you release your contingency, If you decide to cancel 2 days later, for example, you could risk losing your deposit. So you want to make sure that you feel good about this property before releasing that contingency. And then as a lender, we're going to issue to you your final closing disclosure, and that gives you a 3-day cooling off period before we get to the very final stage, which is called closing your loan. And closing your loans, the final stage, but it's also where you're going to go meet with a public notary to sign your final loan documents. That process will take about an hour or so. And then at that time, once the signing is completed, you'll then go to your bank to make your final deposit of funds. Usually it's done by wire to the escrow company. And as a lender, we're going to complete one final audit of your financing to make sure that, all the documents are signed correctly. You've contributed the funds that you're supposed to. The escrow team, who you have sent your funds to, not only the deposit and the final funds, will do a final balance of everything, making sure you've contributed what you're supposed to as a buyer and the seller's receiving the proceeds expected. And if everything balances out okay, then as a lender, we're going to wire in the funds of your mortgage. And then maybe if you've elected assistance program, we'll wire that in too as well. And that money gets reconciled. And once that's all settled, the escrow team will release the recordable documents to the county recorder's office. And they record a grant deed, and that transfers ownership to you. They also record a deed of trust, which is your agreement to repay the loan. And so once all that gets confirmed as recorded with the county recorder's office, that's when you become the official owner of the house. You get a chance to high five and celebrate the big accomplishment, because we understand it is probably going to be the biggest purchase you're going to make in your lifetime. So it doesn't come without stress and anxiousness and all that stuff, but we do our best to try to support you through that process. As I mentioned earlier, we do consultations with all of our clients, and that's where we get a chance to put together a home buying game plan for you. And so we really encourage all of our guests that attend these workshops to meet up with us for a consultation. That consultation, in advance of it, will start with an online application. We'll do that soft credit pull for you. You'll upload documents. And then when we meet up for that video consultation or phone consultation, if you prefer, we're going to get a chance to design the budget. We're going to figure out what the interest rate offering makes most sense for you, look at different payment scenarios. We'll go through the process again. And like I said, the output of that will be for your pre-approval. Now, after leaving tonight's class and you just got a few questions that you want to kind of maybe connect with us on, really encourage you to sign up for an intro call. That's where we can get a chance to kind of maybe talk about maybe your credit situation or maybe your savings goals, or maybe just have some questions that you want to kind of follow up with before going to the next steps, which would be a consultation. Here's the framework of a consultation. Like you've heard already, the affordability, talk a little bit about where you want to buy, because that's obviously going to drive maybe some of your purchase price. Looking at different loan terms, interest rates, your closing costs, your credit review, the 6 steps of home buying, and then again, that pre-approval letter. This is that mobile app. I think I mentioned this to you earlier when we talked about different payment calculations. Really encourage you to download that for either Android or Apple. I think it's a great tool for you to use in your home buying. You can also follow the kind of the progress of your loan as you go from pre-approval all the way to the final stages of the process. Now, we have several different partnerships, alumni partnerships across California and other states. In fact, we just launched a new partnership with Sac State here locally in Sacramento. But we have some awesome partnerships down in Southern California as well. And we pass along a $750 discount in closing costs for any of the members of those alumni associations, or even for state employees. So really encourage you to check that out. Those consultations that we do are all free services we provide. So whether you're going to buy next month, next year, or 5 years from now, we just want to help build a plan for you so you can kind of get down that path towards homeownership. And like I said, this is probably going to be the biggest investment you make in your lifetime. So we just want to be your trusted mortgage advisor along that journey. Okay, so that brings us to the end of tonight's discussion. We have some fantastic workshops coming up too over the next several months. Like I mentioned earlier, these are open to the public. You're free to invite friends, family, colleagues that might learn a little bit more to help them on that path towards homeownership. This is our upcoming class schedule, and you can register at mortgageeducate.com for more details. So I'm going to go ahead and hang out online for a little bit, and then if we have any questions to answer for our group, and then we'll go ahead and wrap up. So I'm going to go ahead and mute out for right now and wait for some questions to come in. And you're welcome. That wasn't a question, that was a response. Okay, we'll give it a few more minutes here and see if there's any questions that come up. Again, if you do have questions that maybe you don't want to have asked or answered on air, we can always connect for an intro call. That's not a problem at all. Okay. I think we're good. So, oh, maybe not. We did have a question that came in, and I don't know if I can really answer much of this. The question was, can you go over Biden's $25,000 bill? I'd have to do some research on that. There's a lot of first-time homebuyer and affordability, homeownership affordability bills that are out there. I can do some research on it. I think, there's a lot of stuff going through legislation. We have to see kind of how that kind of plays out, gets to the marketplace. But I believe that one may be a tax credit, if I'm not mistaken. In California, there's I think it's called homeownership for all in California. There's something going through state legislation right now. Hopefully that gets announced here soon, hopefully in the next 2 to 3 months. But there's a lot of different things kind of coming through the pipeline. I would encourage you to kind of follow us on our social channels, just stay connected with us in general, because as things kind of roll out to the marketplace, we'll certainly share those with our first-time buyers. Okay. All right, very good. Well, I know we're kind of limited on our questions tonight, but feel free to get connected with us, afterwards. Oh, I got a question came in. Okay, how do I know? Here's the question that came in. How do I know the condo I'm buying is qualified for FHA loans? Okay, good question. So, unfortunately, most condos in California are not qualified under FHA, but there is an approved FHA condo portal, if you will. I can get that sent out to you afterwards, and we can share that in the chat, I guess. But the downside is most FHA developments are not, or condos are not FHA approved. Now, CalHFA, which is the first-time buyer program we talked about, that's the assistance program. CalHFA is different because you have a conventional loan and an FHA loan underneath it. Ideally, if you're purchasing a condo, you would want to go conventional because it'll make it a little bit more easier from a financing perspective. Okay, and like I said, we'll get you that FHA approved condo list, and then you can that portal is pretty easy. You just type in the county, and it's pretty easy. So another question came in: is it better to apply for a CalHFA compared to a conventional loan? That really just depends. Everybody's situation is a little bit different. I certainly think if you're eligible for the low income program, which is the equity builder program, that is a great opportunity because it's 10% of your purchase price, interest free and forgivable. I'd really encourage you to check that out. If you're buying, depending on the type of property you're buying too, especially for clients who are buying condos, conventional CalHFA can be lower than a traditional conventional loan because traditional conventional loans have a higher interest rate point on condos than say a single family residence, but there's no differential when it comes to CalHFA loans. So to better answer your question, I think it would be important for you if you're trying to compare CalHFA versus conventional. I really encourage you to do a consultation with us just to see what that side-by-side comparison looks like. And okay. Perfect. Anybody else with questions that I can help answer? Okay. All right, very good. Well, I appreciate everyone joining us on a busy Wednesday evening.